Usually when we talk about medical diagnosis, there's this expectation of precision,
Hmm.
like engineering.
Right. You expect it to be very binary.
Yeah, exactly. You break your arm, the
Yeah.
X-ray shows that jagged white line, and the doctor just points and says, there it is. Broken or not broken, it's clean.
It is. But then you step into the world of, say, neurodevelopment or trauma, and suddenly that X-ray machine is entirely useless.
Right, the whole diagnostic landscape just gets completely murky.
It is the absolute definition of diagnostic muddy waters.
And honestly, that is exactly what it feels like trying to diagnose the global economy today. It is Tuesday, April 14th, 2026, and we are looking at a stack of material for this deep dive into the source material that reveals a world of, well, extreme, almost dizzying contradictions.
Dizzying is a pretty good word for it.
Right. Because we have stock markets hitting new all-time highs, while simultaneously a major global shipping lane is under a literal military blockade. We are witnessing trillion-dollar artificial intelligence infrastructure deals being inked in the exact same breath as literal firebomb attacks on tech CEOs in their own homes.
Yeah, the physical reality is violently colliding with the digital one.
Exactly. And right down at the street level, everyday consumers are stretching their monthly budgets to the absolute breaking point just to buy a standard commuter car. Okay, let's unpack this because the friction between the macro headlines and the micro reality, it's just deafening right now.
That friction is exactly what we need to examine today. The goal here is to connect the dots between the global macroeconomic reality, the day-to-day pressures that are squeezing you, the consumer, and the bleeding edge of technology.
Because it's all connected, even if it doesn't look like it on the surface.
Precisely. To understand how all of these elements are reacting to one another in real time, we really have to look past the isolated headlines. We need to break down the underlying mechanics driving this massive divergence.
So we have to start with the widest possible lens, which is the geopolitical landscape.
Yeah.
Because right now, the flashpoint dominating the global stage is between the U.S. and Iran. And to you listening, we want to be absolutely clear right up front. Our role here is to impartially report the facts directly from the materials in front of us.
Right. We are just looking at the data.
Exactly. We are not taking sides. We are not making moral judgments, and we are not endorsing any political or military actions whatsoever. We are simply conveying the information exactly as it has been reported in the sources.
And the facts on the ground right now are that the U.S. has begun blockading Iranian shipments in the Strait of Hormuz.
Which is a huge deal.
Massive.
Yeah.
To understand the gravity of this, you have to understand the geography. The Strait of Hormuz is not just some random shipping lane. It is the ultimate global maritime choke point.
It's that narrow stretch of water right between the Persian Gulf and the Gulf of Oman, right?
Exactly. And it is responsible for roughly 1/5 of total global oil flows. So when you bottleneck that specific waterway, you are essentially placing a tourniquet on the global economy.
And the diplomatic situation surrounding this tourniquet is incredibly delicate right now. A fragile 2-week ceasefire has severely frayed over the last few days.
Yeah, both sides are pointing fingers.
Right, both the U.S. and Iran are accusing each other of violating the conditions of that truce. However, the White House has confirmed that a second round of peace talks is reportedly under discussion. President Trump was actually quoted on Monday saying, "We've been called by the other side," and he added they'd like to make a deal very badly.
But then on the other side of that rhetoric, you have Iranian officials pushing back hard.
Yeah, like Parliamentary Speaker Mohammad Bagher Ghalibaf. He warned that this blockade is a boomerang that will just drive up global energy prices. He explicitly said people will soon be nostalgic for $4 to $5 gas.
And the economic stakes of this blockade, if it actually holds, well, they cannot be overstated. We have an estimate from Harvard Kennedy School academic Linda Bilmes, who is a very prominent public policy expert.
It was a projection.
She projects that this war could ultimately cost U.S. taxpayers $1 trillion.
Wow. $1 trillion.
Yeah. Now, step back and look at the corporate interpretation of that same exact event. Citadel CEO Ken Griffin spoke at the Semaphore World Economy Conference and laid out a very stark, mechanical timeline.
I read this quote. It was pretty chilling.
It really was. He warned that if the Strait of Hormuz remains shut down for the next 6 to 12 months, a global recession is, in his exact words, inevitable.
Inevitable. But Griffin also noted a massive secondary effect that I find super fascinating. He said this blockage will force a massive accelerated shift toward alternative fuels, specifically wind, solar, and nuclear.
Right, it changes the entire incentive structure.
Exactly. Like the geopolitical pressure is functioning as this hyper-catalyst for a global energy transition. It's not about being green anymore. It's about sheer survival.
What's fascinating here is the underlying mechanism of capital allocation. When traditional energy supply chains are fundamentally threatened, and I don't mean just by price fluctuations on a trading screen, but by physical military blockades at key global choke points, nations and major corporations do not just sit there and absorb the cost indefinitely.
They pivot.
They absolutely pivot. The extreme friction in the fossil fuel supply chain accelerates capital expenditure into alternatives that offer sovereign energy security.
Right, so you're not relying on a shipping lane halfway across the world.
Exactly. Nuclear, solar, and wind suddenly transition from being these sort of environmental ESG initiatives into becoming urgent national security and economic stability imperatives. It's essentially a forced technological evolution driven by military reality.
But here's the bizarre contradiction. This is where I really need you to explain the psychology of Wall Street to me. Despite the blockade, despite the threat of a $1 trillion price tag, despite the Citadel CEO saying a recession is inevitable, the financial markets are acting like everything is completely fine.
Yeah, they really are shrugging it off.
The reporting shows that global markets are moving past what analysts call peak fear. The S&P 500 erased all the losses it suffered since the Iran war began. It actually rose 1.1% in a single day to sit just 1% below its 52-week high.
Which is wild when you think about it.
Right. And oil prices. You would intuitively think a blockade on 1/5 of the world oil would send prices into the stratosphere. But West Texas Intermediate actually dropped 2.8% down to $96.31 a barrel. How does that make any logical sense?
The drop in oil is a perfect lesson in how markets price in future rather than current realities. You have two forces at work here. First, the diplomatic rumors. Any whisper of peace talks prices some risk premium out of the barrel immediately.
Okay, that makes sense. Buy the rumor, sell the news kind of thing.
Right. But the second, much heavier force is what analysts call demand destruction forecasts.
Demand destruction. That sounds catastrophic, but you're saying it actually lowers the price?
Exactly. The International Energy Agency is looking at this conflict and projecting that the resulting higher average prices, combined with the general economic slowdown caused by the conflict, will literally destroy demand.
Oh, I see.
Yeah, if it costs too much to run a factory, the factory slows down its production. If consumer goods become too expensive because of shipping costs, people buy fewer goods, so fewer ships sail, the overall need for oil contracts.
So the market algorithms project that the reduction in global demand will actually outpace the reduction in global supply.
Precisely. That brings the price down, even with the Strait of Hormuz restricted. And as for the equities market rallying, we are seeing investors treat this geopolitical shock as a temporary catalyst rather than a permanent structural impairment.
But not everyone on Wall Street is buying into this Teflon market theory. Greenlight Capital's David Einhorn, and keep in mind, his fund actually outperformed the S&P 500 by returning 6.5% in the first quarter. He is preaching extreme caution right now.
He is. He's explicitly prioritizing capital preservation over aggressive growth.
Einhorn's positioning is telling because he is a value investor who focuses intensely on fundamentals. Greenlight had already reduced its market exposure before the conflict even began, citing stretched, expensive valuations.
And they've made very few adjustments since the blockade started.
Right. Aside from adding a long position in October oil futures and some medium and small stakes in a few companies, he is fundamentally questioning the market's current risk-reward calculus. He's looking at the broader picture and concluding that the market is just completely mispricing the downside risk.
He had this incredible quote to describe investor psychology right now.
Oh, yeah, the Sammy Hagar quote.
Yes, he said, investors have a Sammy Hagar-inspired mentality, one foot on the brake and one on the gas.
Because nobody wants to miss the V-shaped recovery. Let me ask you, how does that actually manifest in a portfolio? How do you keep one foot on the gas and one on the brake at the same exact time?
It manifests as intense internal portfolio contradiction. It means an institutional investor might hold a large cash position or buy defensive assets like treasury bonds.
So that's the foot on the brake.
Right. But simultaneously, they are heavily weighted in high beta tech stocks or AI companies because they are terrified that if a diplomatic resolution happens tomorrow, the market will surge 5% and they will underperform their benchmark.
And that's the foot on the gas.
Exactly. It's a conditioned response. Over the past decade, market participants have been trained to buy the dip because central banks have repeatedly backstopped catastrophic losses.
Right. The Fed put.
Yeah, the numbness we are seeing is a recalibration of risk tolerance driven by intense FOMO, the fear of missing out.
Which brings us to the inflation data, because the Federal Reserve's next move is the ultimate arbiter of whether that FOMO is actually justified. We just got the March wholesale prices, the Producer Price Index, or PPI.
And the numbers were surprisingly soft.
Very soft. It rose only 0.5%, which was significantly less than the 1.1% that economists had expected. And core PPI, which strips out highly volatile food and energy sectors, was up just 0.1%.
That data point is vital. The PPI measures the costs for producers, the factories, the suppliers. It's an early warning system for consumer inflation.
Because if it costs a factory less to make a good, they theoretically won't pass price hikes down to the consumer at the store.
Exactly. Treasury Secretary Scott Bessent was out speaking about this, and he explicitly noted this moderation in inflation. He backed rate cuts, stating he is highly confident that core inflation is firmly under control.
But he threw in a massive caveat there, didn't he?
He certainly did. He added that he completely understands if the Fed wants to wait for some clarity due to the war's impact.
So you have the Treasury Secretary subtly green-lighting rate cuts, acknowledging the math supports it, but openly acknowledging the geopolitical wild card that could upend the entire board.
It's a very delicate tightrope walk for the Treasury.
Here's where it gets really interesting to me. Who is actually navigating this incredibly complex, high-tension environment? The materials highlight a fascinating generational shift. Gen Z investors, those born between 1997 and 2012, they are starting to invest at an average age of 19.
Which is remarkably young compared to previous generations.
Right. For context, baby boomers started investing at an average age of 35. Because they are starting so early, Gen Z is mathematically expected to face roughly 15 bear markets during their working years.
And if we connect this to the bigger picture, the psychological imprint this will leave on Gen Z's capital allocation is profound.
How so?
Well, early market declines, especially ones driven by wars or massive pandemics, can make the market feel like a fundamentally unsafe place. But the sheer volume of time Gen Z has in the market demands that they stay invested in equities to outpace inflation over a 50-year horizon.
It requires a completely different emotional fortitude compared to a boomer who, entered the market during the relatively stable, prolonged bull runs of the 1980s and 90s.
Exactly. Gen Z has to normalize extreme volatility as a standard feature of their financial lives. They are learning to build wealth in an environment where geopolitical shocks, massive technological disruptions, and rapid inflation spikes are just a standard Tuesday.
Just another Tuesday.
Yeah.
Now, let's look at a sector that is supposedly a massive vulnerability in this high-interest, high-volatility environment, the private credit market. There has been a massive amount of anxiety about loan defaults in this space.
Yeah, this is what some people refer to as shadow banking.
Exactly. Some analysts are mapping out worst-case scenarios of a 15% default rate. But Blackstone's global head of private wealth, Joan Solotar, aggressively pushed back on this panic.
Yeah.
She had this quote where she said, "You've had all these calls that the house is on fire when what we see is maybe a piece of burnt toast."
Yes, her defense is rooted deeply in the structural mechanics of private credit.
Okay, I have to push back here. Explain this to me like I am a complete novice. If 15% of the people who owe you money suddenly default and stop paying, how on earth is that just burnt toast? That sounds like a catastrophic systemic collapse. How does a 15% default rate not tank the entire fund?
It's an excellent question, and to understand it, we really have to define what private credit actually is and how the math works. Private credit essentially means non-bank lending.
Okay.
Instead of a medium-sized company going to JP Morgan for a loan, they go to an investment firm like Blackstone. These loans are typically senior secured, meaning if the company goes bankrupt, Blackstone is first in line to take the company's assets. That's the structural protection.
Okay, so they have collateral to fall back on.
Exactly. Now let's look at the math of the yield. Let's say a private credit fund is currently returning 9% annually to its investors. Joan Solotar's point is that even if a severe stress scenario occurs where a 15% default rate is spread out over 3 years, you aren't losing 15% of your total fund value.
Because of the collateral.
Yes, because of recoveries from that collateral and the high interest being paid by the 85% of companies that are not defaulting, the actual loss to the fund's overall yield is roughly 300 basis points.
Stop right there. Basis points. For the uninitiated, what does that translate to?
A basis point is simply 1/100 of 1%. So 100 basis points equals 1%.
Got it.
Therefore, 300 basis points is a 3% reduction. So if credit spreads widen and defaults rise to that 15% level, the private credit fund's returns might drop from their current 9% down to 6%, or maybe from 6% down to 3%.
Ah, I see. You're still making a positive return.
Precisely. You are still in the black.
Hmm.
Solitar's arguing that even in a worst-case scenario where you only yield 3 to 5%, private credit is still vastly outperforming its public market equivalents like publicly traded high-yield bonds, which might be deeply in the red during a crisis.
Right, because public bonds take a massive hit on their principal value.
Exactly. She's pointing out that private credit loans are intimately negotiated, often with strong protective covenants, and firms monitor the exact financial health of the borrower on a monthly basis. It isn't a shadowy abyss. It's a highly structured, risk-priced asset class.
So she views this current environment as a stress test that will actually prove the resilience of the asset class, not destroy it.
That is exactly her argument.
Okay, so we've mapped out the macro pressure cooker.
Right.
We have geopolitical blockades, accelerating energy transitions, a highly tensioned stock market driven by FOMO, cooling wholesale inflation, and a private credit market bracing for impact.
It's a lot of moving parts.
It really is. Now we have to zoom in. We need to move from the theoretical macroeconomy down to the literal balance sheets of the biggest banks and ultimately down to the wallets of everyday consumers. Because the contradiction between high finance and the street level is staggering right now. Let's start with Wall Street.
The first quarter earnings from the major money center banks give us a direct, real-time look at the plumbing of the financial system. Both JP Morgan Chase and Citigroup posted massive Q1 earnings beats. Let's look at JP Morgan first. They reported $5.94 per share on over $50 billion in revenue.
$50 billion in one quarter. And what drove that massive beat?
Volatility. A huge driver was their fixed income trading desk, which surged 21% to generate $7.08 billion in revenue.
Wow.
When the world is chaotic, when oil prices are swinging, when interest rate expectations are shifting daily, when currencies are volatile, corporate clients and institutional investors need to hedge their risks. They go to JP Morgan's trading desks to buy those hedges. JP Morgan capitalizes on the very uncertainty we were just discussing.
Okay, but here is the crack in the foundation for JP Morgan. Despite this massive win on the trading floor, CEO Jamie Dimon actually lowered their guidance for full-year net interest income.
Yes, that was a huge signal.
He brought it down from an expected $104.5 billion to about $103 billion. And he explicitly cited an increasingly complex set of risks, specifically calling out wars, fiscal deficits, and elevated asset prices. Explain net interest income to me, because that feels like the real canary in the coal mine here.
It absolutely is the canary. Net interest income, or NII, is the core traditional engine of a bank. It is simply the difference between the interest a bank earns on the loans it gives out and the interest it pays out to customers holding deposits.
Right, the spread.
Exactly. If Dimon is lowering the guidance for NII while simultaneously reaping billions from trading volatility, he is sending a very clear signal. The fundamental lending and borrowing environment is facing severe headwinds.
So they see trouble coming on Main Street.
Yes. It means they expect loan demand to soften, or they expect to have to pay more to keep deposits, or both. The bank is feasting on the chaos of the trading floor, but they see the underlying foundation, the everyday borrowing and spending by businesses and consumers, beginning to show severe stress.
We see a very similar story playing out at Citigroup. They posted their best quarterly revenue in a decade, $24.63 billion. CEO Jane Fraser highlighted a metric that stood out, a 13.1% return on tangible common equity.
Yes, ROTCE, return on tangible common equity. This is the ultimate metric for evaluating a bank's profitability.
Break that down for me. Why tangible equity? What does that mean?
Tangible common equity strips out the intangible assets on a bank's balance sheet, things like goodwill from past acquisitions or the value of a brand name. It looks purely at the hard physical financial assets the bank holds.
Okay, so just the actual cash and liquid assets.
Exactly. ROTCE tells investors exactly how much sheer profit the bank is generating from the hard cash and physical assets it actually possesses. Hitting 13.1% is a massive win for Citigroup. It's their highest since 2021, and it beats their own internal turnaround target.
And like JP Morgan, they were heavily boosted by fixed income trading, which jumped 13%. But here's the flip side, the warning sign. Citigroup's provision for credit losses was higher than expected, coming in at $2.81 billion. And they specifically noted this was driven by net credit losses in consumer credit cards.
This raises an important question about the true state of the economy. The banks are actively setting aside billions of dollars more because they are observing real-time stress on the consumer.
So the trading desks are profiting from institutional uncertainty, while the risk officers are preparing for consumer defaults.
That is the exact dynamic playing out inside these institutions.
Let's follow that thread directly to Main Street. If the banks are worried about consumer credit, we have the exact data pointing to why they are terrified. Let's look at what it takes just to buy a standard commuter car in April 2026. The numbers are staggering. A record 22.9% of financed new car purchases are now for 84 months or longer.
That is 7 full years.
7 years to pay off a car. A decade ago, that number was only 10%.
It is a profound symptom of extreme affordability strain. The average new car sticker price has remained over $50,000 for 12 consecutive months, and the average amount financed is now roughly $43,899.
This is wild.
What we are seeing is that consumers are quite literally stretching the timeline of their debt just to make the monthly math work. The sticker price is immovable, so the only variable they can manipulate is time.
Wait, let's actually do the math on that. Pull those numbers up.
Yeah.
If I walk into a dealership today and finance that average $43,899 over 84 months, at the current average rate of 6.9%, what is the actual damage?
Let's run it. At 6.9% for 84 months, your monthly payment is roughly $660. Over the life of that 7-year loan, you'll pay $11,575 strictly in interest. Your $43,000 car effectively cost you over $55,000.
But it gets worse, right? Because that's for a prime borrower. What about someone who is really struggling?
For a subprime borrower, someone with a credit score between 500 and 600, the average rate jumps to 13.17%. That exact same $43,899 loan becomes an $803 monthly payment. Oh my God.
And over 84 months, they will pay an astonishing $23,525 just in interest.
This is what blows my mind. Cars are depreciating assets. New cars typically lose about 20% of their value in the first year alone. When you stretch a loan out to 84 months, the depreciation of the physical metal in your driveway far outpaces the speed at which you are paying down the principal of the loan. You are underwater almost immediately.
This creates a severe structural trap known as negative equity. You owe the bank more than the asset is worth. And because the loan is so long, you stay underwater for years.
The reporting shows that about a third of buyers trade in cars with negative equity, and they just roll that remaining debt balance into the new car loan. Are we fundamentally altering what it means to actually own something? If you're underwater on a depreciating asset for nearly a decade and you just roll that debt into the next vehicle, it feels less like ownership and more like a highly penalized permanent subscription service for mobility. A permanent subscription service for mobility. That is an incredibly sharp way to frame the reality. The core concept of building equity in physical assets, which has historically been the bedrock of middle-class wealth creation, is completely eroding.
It's vanishing.
When a vehicle becomes a rolling negative equity trap, it restricts economic mobility in a very real way. It means hundreds of dollars a month that could have gone into a 401k, a college fund, or a down payment on a house are instead being vaporized as interest payments on a depreciating asset. The 84-month car loan is a financial band-aid that masks a deep structural decline in consumer purchasing power.
And navigating this environment requires extreme hustle, especially for small business owners who are feeling this exact same pinch across their entire supply chain. We saw a notable move from Capital One this week that highlights this survival mode. They are rebranding their Spark Miles card to the Venture Business Card.
Right, trying to tap into that existing brand equity.
Exactly. To attract businesses in this tight economy, they are throwing massive, unprecedented incentives out there.
They are offering up to 150,000 bonus miles if a business hits specific spend tiers. It's 75,000 miles for spending $7,500 in the first 3 months, and another 75,000 if you hit $30,000 in 6 months.
That's a huge sign-up bonus.
It is. It has a $95 annual fee, but they are offsetting it by offering new $50 travel credits and $50 software credits.
It's fascinating to look at this right after discussing JP Morgan. You have the biggest banks in the world making billions hedging geopolitical risk, and on the ground, a local landscaping company or a freelance designer is trying to time their equipment purchases to earn a $50 software credit just to keep their margins from collapsing.
That is the profound duality of the economy right now. Capital One's rebrand is highly strategic. Consolidating the brand identity under the highly successful venture moniker makes sense marketing-wise, But the 150,000 bonus miles is an aggressive customer acquisition play during a time of extreme stress.
They know exactly how thin these margins are.
They know small businesses are fighting inflation tooth and nail. By offering flexible travel rewards and practical software credits, Capital One is trying to capture the transaction volume of businesses that are desperate to maximize the return on every single dollar they spend just to stay afloat.
Okay, so we've covered the macro tension, the banking reality, and the consumer survival tactics. Now, we are going to shift gears entirely. We are transitioning from traditional finance to the absolute bleeding edge. We are looking at the sector that is arguably single-handedly holding up the stock market's artificial intelligence.
This is where things get really wild.
Because what the materials show is that the AI boom is no longer just about software, coding, or chatbots. It is rapidly becoming about physical power grids, cyber warfare, and extreme, visceral, real-world backlash. The digital revolution is demanding physical territory.
We are witnessing the physical manifestation of the digital revolution. The sheer scale of capital, energy, and physical infrastructure required to sustain the AI boom is completely rewriting industrial priorities across the globe.
Let's start with the trillion-dollar infrastructure boom. NVIDIA stock is on an absolute tear. You're on a 10-day winning streak, up 18% over that stretch. This is their longest winning streak since 2023. And CEO Jensen Huang revealed at their GTC conference that NVIDIA has an astonishing $1 trillion in GPU orders lined up through 2027.
$1 trillion in backlog.
Yeah, that includes their current Blackwell architecture and their next-generation Vera Rubin GPUs.
To put a $1 trillion backlog into perspective, we really have to look at how NVIDIA's core business has mutated. Data center revenue now accounts for 88% of NVIDIA's entire business.
Wow.
5 years ago, they were primarily a gaming hardware company selling graphics cards to teenagers. Today, they are the foundational bedrock of the global AI economy. The entire technological future relies on their silicon.
And they aren't resting on their laurels with silicon either. They just announced Ising, a new open-source quantum computing model aimed at accelerating quantum adoption. The sheer dominance of NVIDIA is so vast that they actually had to formally deny rumors this week that they were trying to acquire legacy PC makers like Dell or HP.
Yeah, that rumor was everywhere.
They stated clearly they are not engaged in discussions to acquire any PC maker.
It shows how far the balance of power has shifted when people just assume the chip designer might buy the companies that traditionally built the computers. But the chips themselves are only half the battle. Building the GPU is the easy part. The hard part is powering it.
This brings us to a massive deal between Oracle and Bloom Energy. Oracle has expanded a capacity deal with Bloom Energy to procure up to 2.8 gigawatts of fuel cell systems, specifically for their AI data centers. Think about the scale of that number. Oracle has already raised over $100 billion in debt just to support this data center build-out.
It's an unfathomable amount of capital.
And Bloom Energy's stock soared 20% on the news of this partnership. Explain to me what 2.8 gigawatts actually looks like, and why is Oracle buying fuel cells instead of just plugging these data centers into the local power grid?
2.8 gigawatts is a staggering amount of power. For context, 1 gigawatt is roughly enough to power 750,000 homes.
Wait, so almost 2 million homes worth of power?
Yes. So 2.8 gigawatts is the equivalent output of multiple nuclear reactors designed to power millions of homes dedicated entirely to servers. And to answer your question about the grid, well, the traditional power grid simply cannot support this.
Why not?
AI data centers don't operate like traditional cloud storage servers, which have variable power draws. When a tech company is training a massive AI model like a GPT-5 or equivalent, it requires thousands of GPUs running at 100% capacity continuously for months at a time. If the power grid dips for even a fraction of a second, the training run can fail, costing millions of dollars in lost compute time.
Oh, wow. So they need guaranteed uninterruptible power.
Exactly. And that is where Bloom Energy comes in. Bloom makes solid oxide fuel cells. Without getting too bogged down in the chemistry, these fuel cells take a fuel, usually natural gas or biogas, and convert it directly into electricity through an electrochemical process without burning it.
So it's much cleaner than a traditional gas plant.
It's highly efficient, and more importantly, it's generated directly on site. Oracle is buying these because they are realizing that the bottleneck for AI supremacy is no longer securing the silicon chips, it is securing the electricity to run them. Tech companies are being forced to become sovereign energy companies, building massive off-grid power plants just to ensure their models can train without interruption.
But the physical power draw is just one constraint. There is a deeply concerning dark side to this AI supercycle, specifically regarding cybersecurity. JP Morgan CEO Jamie Dimon, on that same earnings call where he lowered his traditional banking guidance, issued a stark warning about AI.
This was a very sobering part of the call.
He revealed that JP Morgan is testing Anthropic's new Mythos AI model. And Dimon explicitly said, AI's made it worse. It's made it harder. He noted that Mythos found thousands of vulnerabilities in corporate software.
If we connect this to the bigger picture, AI is functioning as a double-edged sword of unprecedented sharpness in the cybersecurity realm.
Let's define the stakes here. When Dimon says it found vulnerabilities, we are talking about zero-day exploits, right? Explain what a zero-day is and how AI completely changes the game.
A zero-day vulnerability is a flaw in a piece of software that the software's creator doesn't even know about yet.
No.
Because they don't know about it, they've had 0 days to fix it. Imagine building a massive bank vault but accidentally leaving a secret tunnel under the floorboards that you forgot about.
Right.
Now, traditionally, human hackers spend months probing code to find one of these tunnels. But an AI model like Mythos can scan tens of millions of lines of code in seconds and identify thousands of these forgotten tunnels simultaneously.
Which sounds great if you are the bank and you want to patch them before someone finds them.
It is great for defense, but the asymmetry is terrifying. Bad actors, state-sponsored hackers, ransomware syndicates, they have access to similar or even the exact same open-source AI tools. It creates a hyper-accelerated arms race.
Because they can scan just as fast as the banks can.
Exactly. The AI can automatically discover and exploit vulnerabilities at a speed that human security teams simply cannot match. Dimon's point was that while a bank like JP Morgan spends billions on internal defense, the interconnected nature of the financial system creates massive systemic risk. If a small third-party vendor gets compromised by an AI-driven attack, it could provide a backdoor into the entire financial network.
And while the AI is rewriting the rules of cybersecurity, the very CEOs building it are openly debating what it means for the human workforce. We have a fascinating public disagreement happening at Anthropic, one of the leading AI labs. Jack Clark, the co-founder, openly pushed back against his own CEO, Dario Amodei.
Yeah, this was a very public clash of visions.
Amodei had previously hypothesized that AI could drive the unemployment rate as high as 20% in the next 5 years.
A 20% unemployment rate would be higher than anything seen since the Great Depression. It would be a society-altering event.
But Jack Clark completely dismissed this apocalyptic vision. He argued that AI will augment work rather than entirely displace it. He focused on education, stating that students need to learn how to connect disparate disciplines and solve complex, multivariable problems, rather than just learning rote programming, which the AI can now do better anyway.
It's a critical debate about the velocity of disruption. Currently, the data shows widespread but relatively shallow adoption. Gallup reports that 50% of U.S. employees use AI in some capacity, but only 13% use it daily.
So we're playing with it, but not relying on it yet.
Right. Companies are scrambling to figure out how to integrate it structurally. Look at Infosys, the massive IT consulting firm. They are currently undertaking a massive initiative to reskill all 300,000 of its employees on AI tools. The consensus among the more pragmatic executives is that AI won't replace the worker. It will replace the worker who doesn't know how to partner with the AI.
But that nuance doesn't always translate to the general public. And this is where the story takes a truly dark turn. The existential dread surrounding AI, the fear of a 20% unemployment rate, the fear of autonomous cyber weapons, the fear of society being fundamentally altered has spilled over into the physical world.
It has become violently tangible.
This isn't theoretical philosophy happening on panels anymore. A 20-year-old from Texas, Daniel Moreno Gama, is currently being held without bail in San Francisco because he allegedly threw a lit Molotov cocktail at the home of OpenAI CEO Sam Altman.
It is a deeply disturbing escalation. According to the federal complaint, when authorities apprehended Moreno Gama, he possessed a document warning of humanity's impending extinction from AI.
That is just terrifying.
He explicitly stated his aim to kill Altman, and horrifically, he had a hit list containing the names and residential addresses of several other AI executives, board members, and prominent tech investors.
How do we process this? We are seeing the digital revolution provoke terrifying, visceral consequences in the physical world. The philosophical debates that tech leaders have been having casually assigning probability percentages to human extinction events are being interpreted by some individuals as a literal, urgent call to arms to prevent an apocalypse.
It's a very dangerous rhetoric feedback loop.
Altman actually had to release a statement following the attack, calling for the de-escalation of the rhetoric and tactics within the industry.
It proves that the stakes of this technology are perceived by a segment of the public to be absolute life and death. It raises an incredibly urgent question about the responsibility of the creators of this technology. When tech leaders openly, and sometimes casually, discuss the non-zero probability of their products causing human extinction, it inevitably triggers extreme psychological reactions.
It's inevitable.
The cognitive dissonance is profound. You have the architect of the most advanced technology in human history being attacked with a primitive weapon, a Molotov cocktail, by someone terrified of the future. It perfectly encapsulates the societal fracture caused by the incredible speed of the AI boom.
Here's where it gets really interesting. Because the titans of technology are not slowing down, they are expanding their ambitions into completely new domains. We are shifting to the final portion of our deep dive today, looking at the trillion-dollar bets, mega mergers, and Washington shockwaves that are defining the future. And the scale of these maneuvers is just staggering. Let's look up to the stars first.
The space race is definitely heating up.
The battle for low Earth orbit has officially ignited. Amazon just announced it is acquiring a company called Globalstar for $11.57 billion, paying $90 a share.
This is a massive, highly strategic maneuver by Amazon. They are attempting to supercharge their LEO satellite internet business, which was previously known under the working title Project Kuiper.
Okay, yeah.
The goal is to build their own proprietary direct-to-device satellite system deployed by 2028. This is a direct, multi-billion-dollar shot across the bow of Elon Musk's SpaceX.
Because SpaceX currently dominates this space, right?
Completely. SpaceX currently has over 10,000 Starlink satellites in low Earth orbit, and they are rapidly building out their own direct-to-device cellular capabilities. Amazon realizes that controlling the physical infrastructure of the future internet is an existential imperative for their cloud and e-commerce dominance.
Explain the appeal of low Earth orbit, or EO. Why is this better than the satellites we've used for decades?
Traditional communication satellites are in geostationary orbit, which is about 22,000 miles above the Earth. Because the signal has to travel so far, there is a noticeable lag, or latency.
Like when a news anchor is talking to a reporter overseas.
Exactly that awkward pause. Low Earth orbit satellites operate just a few hundred miles above the surface. The signal travels much faster, providing broadband speeds that rival traditional fiber optic cables, but accessible from absolutely anywhere on the planet, the middle of the ocean, the Sahara Desert, or a remote rural farm.
And Amazon isn't taking on Musk alone. They brought serious backup. Apple is part of this deal. Apple already took a 20% stake in Globalstar back in 2024 to power the emergency SOS feature on iPhone.
Right, they laid the groundwork years ago.
Now, they are part of this Amazon acquisition to guarantee satellite connectivity for future generations of iPhones and Apple Watches. So you essentially have Jeff Bezos and Tim Cook teaming up to break Elon Musk's monopoly in space. And the regulators. FCC Chair Brendan Carr went on CNBC and explicitly said his agency is taking an all-gas, no-brakes approach to expand the U.S. space economy.
Carr's all-gas, no-brakes philosophy really defines this current regulatory era for space. The FCC is signaling a clear willingness to let the titans of tech duke it out in orbit, viewing domestic corporate dominance in next-generation satellite communications as a vital national security interest.
So they want American companies winning this race no matter what.
Exactly. They want American companies controlling this infrastructure. This isn't just about giving people faster Wi-Fi on airplanes. It's about controlling the underlying infrastructure of global data transmission that exists completely outside of traditional terrestrial borders.
Back down on Earth, we're seeing attempts at massive consolidation in legacy industries, though with much less regulatory support. Bloomberg reported that United Airlines CEO Scott Kirby actually floated the idea of a merger with American Airlines to the Trump administration earlier this year. If this happened, it would create a mega airline controlling roughly 40% of all domestic U.S. flight capacity, with 289 overlapping routes.
The antitrust hurdles for a United American merger would be monumental. Most legal experts suggest it would be completely dead on arrival.
Yeah, that seems like a monopoly nightmare.
It would be. The Department of Justice and the Department of Transportation would heavily scrutinize the sheer concentration of market power, knowing it would almost certainly lead to higher airfares and drastically reduce competition for the consumer. However, Kirby's willingness to even float the idea suggests he perceives, or is hoping for, a more permissive corporate regulatory environment under the current administration, even if a full merger is structurally impossible without massive, unprecedented route divestitures.
And speaking of transportation turnarounds, we have an incredibly intriguing pivot in the automotive sector. Lucid Motors, the luxury EV maker that has historically struggled to scale its manufacturing, just named Silvio Napoli as its new CEO. The fascinating part, Napoli isn't a car guy. He spent 31 years as an executive at the Schindler Group.
The elevator and escalator company.
Exactly. The people who make elevators.
Bringing in an industrial manufacturing veteran who spent 3 decades building elevators to run a bleeding-edge EV company is a stark, very revealing pivot.
What does it tell you?
It indicates that Lucid is definitively moving away from the visionary, design-led startup phase of its life cycle. They aren't trying to invent a cooler touchscreen anymore. They're desperately trying to solve the brutal, unglamorous operational realities of mass manufacturing, global supply chains, and strict capital allocation. Building a car at scale is notoriously difficult. Napoli understands heavy metal, motors, and reliable production lines.
And they have the capital to let him try and fix the assembly line. Alongside naming the new CEO, Lucid secured a massive $750 million investment. $550 million of that comes from the Saudi Public Investment Fund, which is their largest shareholder.
They've been a backer for a long time.
But another $200 million comes directly from Uber. And the kicker is the contract attached to that money. Lucid agreed to supply 35,000 specific vehicles exclusively for Uber's future global robotaxi network. So a guy who spent his life building elevators is now tasked with building a fleet of Saudi-backed autonomous taxis.
It really highlights how deeply intertwined legacy transportation, sovereign wealth funds, and autonomous software technology have become. Uber is hedging its bets on the robotaxi future. Instead of building their own cars, they are partnering directly with manufacturers to ensure they have the physical fleet ready when the software is actually perfected.
And for Lucid,
it's a lifeline. They get a massive, guaranteed order book to keep their assembly lines running and generate revenue while they attempt to reach long-term profitability.
Now let's look at how people are actually betting on the outcomes of all these technological and economic shifts. The prediction market sector is exploding. A research report from Bernstein just estimated that prediction markets platforms like Kalshi and Polymarket will grow to a staggering $1 trillion industry by 2030. They estimate it will hit $240 billion by the end of 2026 alone.
The evolution of these markets is the key to that trillion-dollar valuation.
Explain how these platforms work. How is this different from, say, buying a stock?
In a traditional stock market, you are buying a fractional ownership share of a company. In a prediction market, you are buying a contract that pays out based on the binary outcome of a specific real-world event. Will the Federal Reserve cut rates in May? Yes or no?
Okay, I see.
Will the United American Airline merger be approved? Yes or no? The price of the yes contract fluctuates between 1 cent and 99 cents based on market demand, effectively functioning as a real-time probability tracker.
And currently, these platforms are heavily used for sports and politics, right?
Exactly. Currently, sports betting and high-profile political events dominate the volume. But Bernstein's projection of a massive shift to $1 trillion relies on institutional adoption.
So big companies getting involved.
Yes. By 2030, they expect institutional trading around economics, business supply chains, and political contracts to completely take over the volume. Imagine a major shipping corporation that is terrified of the Strait of Hormuz blockade. Instead of buying complex financial derivatives, they might go onto a prediction market and buy millions of dollars of yes contracts on the blockade lasting past December.
Wow, so it's corporate insurance.
Exactly. If the blockade holds and their shipping business suffers, the prediction market contract pays out, hedging their real-world losses. It democratizes complex financial hedging.
Which brings us to the ultimate center of gravity for all of this financial, technological, and regulatory maneuvering, Washington, D.C. And again, to you listening, a firm reminder that we are explicitly reporting the facts from our sources impartially, without endorsing any political viewpoint or taking a stance on any underlying investigations. Let's look at the financial disclosures of Kevin Warsh, the nominee to succeed Jerome Powell as the Federal Reserve Chair.
Warsh's financial footprint is uniquely vast for a Federal Reserve Chair nominee. The mandatory disclosures reveal his personal wealth is estimated between $135 million and $226 million.
That's a massive range.
And that does not include his wife, Jane Lauder, whose personal wealth Forbes estimates at $1.9 billion. What is particularly relevant to our previous topics is that the disclosures show Warsh holds direct financial stakes in both Polymarket, the prediction market we just discussed, and SpaceX.
Now, the reporting notes he has formally pledged to divest those specific assets if he is confirmed by the Senate, but his confirmation process is currently stalled due to political infighting. Senator Thom Tillis, a member of the Senate Banking Committee, has publicly vowed to block Warsh's confirmation vote from moving forward.
It's a significant roadblock.
Tillis is demanding the full resolution of an ongoing federal criminal probe into current Fed Chair Jerome Powell regarding massive cost overruns on a Federal Reserve building project. Tillis stated he will not allow Warsh to move forward until the Powell investigation is concluded. So the future leadership of the world's most powerful central bank is caught in a highly complex political and legal standoff.
And we must contextualize the timing of this standoff. This delay in leadership continuity is occurring exactly when the Treasury Secretary is publicly debating the nuance of interest rate cuts amidst a global conflict and an oil blockade.
The timing couldn't be worse.
The stability and predictability of the Federal Reserve's leadership is a critical variable for global markets, and this confirmation delay introduces a massive layer of institutional uncertainty at a highly volatile moment.
And the political shockwaves don't end in the Senate. We also have major news out of the House of Representatives. Congressman Eric Swalwell, a Democrat from California, has announced he is resigning from Congress. This announcement immediately follows a press conference held by a woman named Lana Drews, who is being represented by high-profile attorney Lisa Bloom. The reporting states that Drews alleges Swalwell drugged and raped her in a West Hollywood hotel room back in 2018.
According to the details released during the press conference, Drews claimed she was incapacitated and did not consent to any sexual activity, stating explicitly that he choked her to the point of losing consciousness. She announced her intention to formally file a police report regarding the 2018 incident.
Swalwell, who had actually suspended his campaign for California governor just the day prior to this press conference, released a formal statement. He forcefully denied any criminal wrongdoing and stated he will fight the allegations, though his statement did include an admission to mistakes in judgment in his past. The reporting also notes that Swalwell is currently reportedly under a separate, ongoing criminal investigation by the Manhattan District Attorney's Office. Okay, we have covered an incredible amount of ground today.
A truly massive amount of ground.
From the geopolitical choke points, to the trading desks of Wall Street, to the 84-month car loans on Main Street, up to the trillion-dollar AI data centers and satellite wars in orbit, and back down to the political chaos in Washington. So what does this all mean? How do we synthesize all of this?
If we look at the totality of the materials we've examined today, a very clear defining meta-narrative emerges. We are living in an era defined by a violent collision of timelines. On the ground level, everyday consumers and small businesses are being forced to stretch their timelines just to survive.
The 84-month car loans.
Exactly. They are taking out 84-month car loans, rolling over negative equity, and hunting for microcredits just to maintain the basic status quo of their lives. The middle-class timeline is expanding, slowing down, and filling with debt. But at the exact same moment, at the macro and corporate level, the timeline is violently compressing.
Because of the AI race.
Yes. The titans of industry are accelerating the AI supercycle at a pace that breaks traditional infrastructure. They are spending hundreds of billions on off-grid power, rushing to deploy proprietary satellite constellations by 2028, and utilizing algorithms that price in global recessions in a matter of milliseconds. The profound tension we feel across the economy, the anxiety we see in the markets, and the physical backlash we see in the streets, it is all generated by the friction between the slow reality of human economic survival and the hyperspeed reality of technological and financial engineering.
And that leaves us with one final, frankly provocative thought to end on today. Consider the trajectory of the infrastructure we just spent the last hour breaking down. We have AI data centers requiring gigawatts of off-grid power, secured by private corporate deals like Oracle and Bloom Energy, completely bypassing the public grid.
They are building their own private utilities.
Exactly. We have mega corporations like Amazon and Apple building proprietary low Earth orbit satellite networks that bypass traditional national telecom infrastructure and terrestrial borders. And we have prediction markets that are scaling to $1 trillion, potentially replacing both traditional political polling and traditional regulated financial hedging. What happens when the titans of technology in Wall Street successfully build a completely parallel, privatized global infrastructure?
It's a profound question.
Could we be heading toward a future where $1 trillion AI model, powered by an off-grid nuclear reactor, executes autonomous financial trades on a private satellite network, operating entirely outside the physical borders, regulatory frameworks, and legal jurisdiction of any single nation-state. Who actually governs the global economy when the infrastructure of that economy no longer physically touches the ground? Thank you for joining us on this deep dive into the source material. We'll see you next time.